This company is considering a new 3-year expansion project that requires an initial fixed asset investment of 2.28 million. This fixed asset falls into a 3 years MACRS class. Project is estimated to generate 1.75 million in annual sales with costs of 652,000. And the project requires an initial investment in net working capital of 330, and fixed assets will have a market value of 300,000 at the end of the project. If the tax rate is 23%, what is the project's year zero net cash flow, year one, year two, year three? Let's handle the year zero immediately. And the net cash flow is cash flow from assets, which is OCF minus net capital spending minus change in net working capital. So for year zero, OCF is obviously zero. Net capital spending is what we spent on the investment. There's no opportunity cost or anything like that. So 2.28 million minus change in net working capital, 330,000. So year zero cash flow from assets or net cash flow is negative 2.61 million. For year one, year two, year three, we need to calculate the OCF first, but since it's MACRS, depreciation is going to vary each year. So let's first calculate EBIT for years 1 through 3. That's sales minus cost. Actually, it's EBITDA. And annual sales of 1.750 minus cost of 652. Okay, 1,098,000. The rest we're going to do in a spreadsheet. Let's go to our template. The purchase cost of the asset is, where art thou? 228. Tax life is 3 years, and it is indeed MACRS. Later on, we're going to need the salvage year, which happens on the year 3. Let's remember the tax rate. Where are you? 23%. And later, we're going to need the salvage value, 300,000. All right. First and foremost, this is EBITDA. Come on, type it correctly. And which we calculated to be 1,098,000. Let's make that into a proper format. for rest of the year, they are the same. So I'm just going to copy them. Net income, EBITDA minus the depreciation for that year times 1 minus the tax rate. Oops. Tax rate is fixed. Yes. OCF is simple. After that, take net income, add the depreciation back. CFFA. In years 1 and 2, there is no change in net working capital, and there is no capital spending in addition to what we already spent in year 0. So it's just OCF. So for year 1, CFFA is 1,020,000. Year 2, CFFA is what you want to call the 1,078,000. But in year 3, in addition to OCF, the money that we spent on net working capital, that is going to return back to the firm. So we're going to add that back in, 330,000 plus the after-tax salvage value, because we sell this product at 330 at the end of year 3, and as far as IRS was concerned, it was worth 168,948, which creates taxes. So after-tax salvage is 269 and some change. So year 3 cash flow is actually 1.5 million and some change.